Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, Salesforce. Right, the stock market, a lot of the big tech names are down 50, 60, 70%. Salesforce itself is down 50% from its peak. From my last review in January where I called it overpriced, nailed it. Let's check it out now. Now that it's half off, how much do we think it's really worth? How much cash flow does it make? If we bought it today and held it for a decade, what do we think we can make over that time? Ready? Let's get to work. All right, as we always do on this channel, we're going to review stocks with 5 key attributes. Number 1, top line revenue growth. It must be there. Number 2, earnings growth. We use EBITDA. Number 3, strong free cash flow. Number 4, low debt. And number 5, well-priced. Now, well-priced stock, that's been the one that's held this company back from our last review, is it was way, way overpriced. It's 63 times earnings. It was incredibly expensive. Now the stock is halved in value. Let's take a look and see what we think. And we're going to kick that off with the Investor Day presentation. Now, we looked at this last time, and I would also encourage you all to clearly read the 10K, do your own due diligence, but this is a quick review of what the investor relations team is putting out into the market. And the first thing you should notice is with this Investor Day, we've got fuzzy little critters here, lots of color, lots of gloss, lots of sales. This is a sales piece. This is not the black and white factual required document that they have to submit in the 10K to the SEC. This is, hey, look at me, I'm Salesforce, look how awesome I am. So it's a sales piece, keep that in mind. I'm gonna pull in a couple slides from here, then we're gonna skip to the detailed black and white numbers, figure out how much cash flow. But before we do that, I just wanna show you a couple things in here that I thought was very interesting. The first thing I want to stop at here is on page 14, where they talk about TAM, total addressable market. You'll see this a lot in the tech startups. Basically, what they do is they take the fact that they're in an industry, they take all the business done by anybody in that industry and say, this is the total addressable market. In this instance, Salesforce is saying that's a $248 billion market that they could address. And they say, well, if I get 10% of that market share, that means I'm $25 billion in revenue. And if I apply a margin on that, let's say 10%, that's $2.5 million of EBITDA. Therefore, and you give me like a 20 multiple on that, therefore I'm a $50 million company. That's how they pitch themselves to VC. Frankly, to the stock market itself, and that's how they get the lofty valuation. The problem with this is TAM has very little to do with how much revenue and earnings they actually make today, or the speed at which they were able to grow that in the future. It's really just a nice glossy chart for people who like to talk about it. But us who are rational cash flow investors, we want to know, what'd you do last year? What'd you do a decade ago? How much free cash do you make? And none of that is here. So let's keep going. So now we get to something real. So we're getting to outstanding revenue for Salesforce. And you can see the absolute meteoric growth, $26 billion last fiscal year. This is estimate. They came in very close to that number, by the way, because most of their revenue is recurring. So it's very easy for them to project near-term revenue. They're also saying that their guidance long-term is $50 million out to 2025. So what we're going to do is we're going to continue that growth forecast forward and see how much, if we assume the price, the growth that they're telling us, if we assume that, how much can we make on the stock and is it well priced? The last thing I want to show is I'm happy they put free cash flow on here. Free cash flow generation, very, very good. $5.5 billion. They ultimately ended up making $6 billion in free cash flow in 2022. Fantastic. We want to see slides like this where they're talking about pure cash generation. A lot of the sales companies don't do that. They simply talk TAM, they talk customers, they talk revenue maybe, but most of them burn money like Ubers and Lyfts and all those just piss away money. But at least Salesforce is making a ton of jack. Let's figure out how much money they keep here and how much the company's worth based on this cash flow. Okay, the next thing we want to do is, because their fiscal year ends in January, it's now May, we want to kind of get an update on what their thinking is before we begin forecasting. So here's their fourth quarter earnings release. And they also issue guidance for the following year, which is what we want. It was not in the presentation. So let's quickly get through this. I don't want to take too much time. Let's get to the hard facts in a second. But here, top line, raised guidance, fiscal 2023 to $32.1 billion of revenue. We're going to go ahead and use those numbers going forward. And it also explains here they got 24% year-over-year revenue growth. So the next thing here, they have operating margin 2.1%. That's pretty low. Non-GAAP operating margin, that's kind of like their EBITDA, 18%. And they're issuing guidance of operating margin of approximately 20% going forward. So we're gonna chime in on that 20%. I'm gonna bring it down a little bit for a hedge. But that's kind of how we're going to use their numbers going forward. Now let's go take a look historically at their information, see what we get. All right, before we dive into the detail behind me of the 10 years of Salesforce, I want to remind you that I've published the Salesforce one-pager on my website. You can go to cashflowinvestingpro.com. In the link below, I give a free one-pager out so you can see what this is, but it's basically 10 years of information, a forecast, a quick summary, and a highlight of the 5 key attributes, if the company meets it or not, that you can find on my website. All right, let's check out the forecast, let's check out the actual results of Salesforce itself. Revenue, 2014, $4 billion. That has grown to $26 billion. So they beat their forecast that they were saying when we looked at it just two minutes ago. $26.5 billion. And every single year here, they have grown their revenue very, very steadily. That's extremely impressive. And this business is sticky. If you're a business, certainly a large business, if you installed Salesforce into your business and you're operating on Slack, it's very, very hard for a business to change that, especially within the accounting function. Now, I'm a CFO as a profession. I've changed ERP systems from one to the next, and it's a huge, huge pain, and it's always more expensive than the consultants tell you. So what I'll say about this company, and the reason I do like the business model here, is it's incredibly sticky. The subscription business makes forecasting a little bit easier from the business perspective because you know what revenue is. It's harder for customers to drop, so you don't have to repeat a sale every single year. You get a lion's share of that money coming back to you. And number two, businesses, the customer they're selling to, it's very hard for that customer to walk away, and they typically get some advance notice or a chance to reprice, or there's some discussion there before the customer simply abandons the service. So I like this. I think that gives you confidence in growing in the future. The question is how fast to grow it. I don't know, but we're gonna take a look at that. So we like this. Then the next thing we want to look at is profitability. Now we measure profitability at this channel at EBITDA. That stands for earnings before interest, tax, depreciation, and amortization. It's basically the cash earnings at the operating level that the business is generating. We do that because if you go above the line, as it's called, at operating income, it excludes things like the closure of operations. It includes some acquisition costs. It includes currency or pension investments or underfunded pension liabilities. It includes some of those things that are not germane to the operation itself. What we want to do here, it's not trying to represent cash flow, it's just trying to find out what's the steady state, the normalized earnings of a business going forward so that we can forecast off of it. That's what we're looking for. And what you can see here is it grows every single year in line with revenue, which is very nice. It's 43%, just because this is negative. I'm pulling off this shorter time frame, but this is very good. Margins are growing faster than EBITDA is growing faster than revenue, so margins are growing. Very, very nice business. Let's look at enterprise value. Now, for those of you who aren't familiar, enterprise value is the value of the entire business. The stock market is just the market cap. The stock market is only this column here, but the true value of a business is this column, and they don't tell you that. You got to be very careful. So how do you get that column? Well, you start with debt. Debt is short-term liabilities, long-term liabilities, capitalized leases, pension obligations. It's the debt, the bonds of the company. It's not payroll. It's not accrued expenses. It's not, what are some of the other line items? Prepaid expenses, well, that's an asset, but there's a lot of other things that can happen in the liability section on the balance sheet. What you want are the one that are bank contracted. And so here you can see $2.5 billion to $14 billion. Now look at this step up. The pandemic struck, and they went to their bank and borrowed a tremendous amount of money, almost $10 billion, more than they had on the balance sheet. And that's smart, frankly. If I were in their position and I had the open lines of credit and the pandemic struck, I would go and pull down as much lines of credit as I can because cash is the lifeblood of any business. And if you don't know what the future holds, you want to hold as much cash as possible because that is time that you can buy to save the business. That's why you hold it. Even if they have to pay it back, which they can. You want to hold that cash. So then here we go, excess cash. Now excess cash, I'm using is the line that they have on their balance sheet, which is cash and cash equivalents. This to me looks like they have a lot more cash on the balance sheet than here, but it is what it is. I'm pulling this line here. So I'll net these two to come up with net cash. Market cap, shares outstanding times price. Their market cap has gone from $35 million to $226 billion. $35 billion, $226 billion of market cap, and that's average price times the share count. When I add up the debt, less the cash, plus the market cap, I get enterprise value. And that is the true value of the business. Much like if you were to buy a house, I've used this example before. If you buy a house, the market price of the house is the enterprise value of that house. You then go to the bank and you borrow money to go buy it. You get a mortgage plus your down payment. You combine the two to go buy the house at the enterprise value price. Same thing here. The value of the business is the enterprise. They have financed that enterprise between debt and equity here and here, and that's how you get the split, but the value of the business is still here. So then what do? Well, then we want to look at a couple metrics. Let's take debt first because it's going to be faster. So debt, I'm taking net debt minus cash, net debt. Divide that by the enterprise value, the value of the business. Divide that by the EBITDA here. I want to know how many years of operating results do they need to pay off all their debt. And for the vast majority of this company has had almost zero debt. Their recent borrowing here actually spiked the debt. And actually, that's probably related to the acquisition of Slack, now that I think about it. I'm sorry about that. I didn't say that earlier. This is probably Slack that they financed. But what it's done is it's raised the debt level to 3 times debt to EBITDA. That's exactly, ironically, that's exactly the number I've been touting this channel for years. 3 times debt to EBITDA is the standard for commercial banks that'll lend to businesses on a senior level. If you go above that, you start getting into junior debt, you start getting into mezzanine debt, preferred equity. There's all kinds of other tranches that you can put in there. But this is, you want to make sure you're buying companies with less than 3 times debt, which this qualifies. The next one is the market multiple. So this is just me taking the value of the business divided by how much EBITDA it makes every year to get kind of a payback period. If I bought the company today, how many years of operating results would it take for it to pay itself off? That's what I want to know. And what you're going to find here is really, really high numbers. I mean, 100 times, 60, leading into the collapse that we had here, it's at 67 times EBITDA, which is very, very high. I will tell you, historically, growth companies are 20, 25 times EBITDA. And here to see something this high, to me, like I said in my last video, I think it's overpriced. And it's going to be very hard for a cash flow forecast to overcome this kind of premium that you're going to pay. All right, let's take a look at cash flow. Before we do, I want to remind you to check out my website. There's a description down below, cashflowinvestingpro.com. I teach a course on how to learn to do this, how to be a financial analyst yourself, build a portfolio of, say, 20 stocks, have forecast models for them so you can more easily track their performance, and then go live your life and not day trade. That investing is about putting money with top-tier management companies who have performed in the past and letting them do their thing. It's a great passive income strategy. All right, let's dive into cash flow itself. Here we go. Cash flow from operations, $876 million to $6 billion. Now, they had 5.5, I believe, in their forecast. They topped it $6 billion last year. And this number has grown every single year, and it's grown roughly 27% annually, which is faster than, which is basically in line with revenue. This is a little high because I started here versus here. That was negative, so this doesn't count. 26% of revenues growth. Cash flow from operations, CFO, growing 27%. That's nice. I like to see earnings and cash flow growing about the same. That means the accounting team is expensing things properly. Now, one giant caveat with this number is this number does not include share-based compensation. And when I go back and take a look at how much they expense every single year in share-based comp, it's in the billions of dollars. In fact, last year, this number, because share-based comp is not a cash expense, it's expense in the P&L. It's expense in the P&L, so it's in this number, meaning this number has been reduced by share-based comp. But because it's not cash, they get to add it back. So this number is much, much higher than it would be had they paid the stock-based comp in cash. $2.8 billion is half this number, right? So if they had to expense that money to employees for payroll rather than giving them in shares, then their cash flow would be half what it actually is. Very, very interesting. We'll take a look at this in a little bit, but let's keep going through the cash flow forecast. CAPEX. CAPEX, if we described before, is how much they have to spend in new infrastructure, technology, desks, manufacturing facilities, equipment, all that stuff to maintain and grow the cash flow. They're a software business. Most of their costs are actually in the P&L itself. They don't capitalize them much. So this is very low relative to this, which we like to see. Like to see a wide margin here. Debt is just the inflow and outflow of debt here. You can see they borrowed $6.5 billion last fiscal year. That led to the jump here in debt that you see. The change here is represented by this individual number here. And then free cash flow to equity. Now, free cash flow to equity, that's what we're buying. If you buy a business, you're buying the free cash flow of the business. Free cash flow to equity is your number. And that is simply the sum of this. Now, there are some caveats to this, right? There's always catches. Nothing is perfect. Well, A, if they borrowed a huge chunk of money in this period, and this number spiked from $4 billion to 11, almost $12 billion, you cannot forecast off this number because it's distorted by this large cash inflow. I use these numbers because I want to know how much debt the company is cycling through, because it's important. In this instance, this is a very reasonable amount of money to assume. This is not. So I would exclude this going forward when we forecast. Shares outstanding have grown over the period of time. Basically, this 8-year period of time, 610 million shares outstanding to 921 million. In fact, they've even grown to 990 this most recent year. This increase in share is the dilution they're giving to the share-based comp. Is the dilution created by the share-based comp that they're giving out. The $3 billion of share-based comp that they created last year diluted our current ownership. So it added almost 70 million new shares outstanding were given to the employees as part of their comp package. Now, you could stop that. If the share price falls like it has, maybe the employees don't want it, or maybe those options aren't exercisable to them. But that's compensation the employees are going to want. That means the business itself might have to pay more in cash to retain those employees going forward. So it's important that we look at cash flow as it's intended. And to retain those employees, they might have to pay that in cash. So we're going to have to adjust these numbers, I think, going forward. But I wanted to give you an idea that the shares are growing. We generally like to see a company that's buying back shares, not diluting our ownership. Finally, free cash flow divided by the number of shares give me free cash flow per share, which realistically is in this range here, rather than this last year when they had a large spike. So if I had to average that, that's probably $3.50 a share. If I just throw in a number out there. Share price and a yield, low single-digit yield is appropriate for a growth company. You typically see that just because the price is so high. This price is so high relative to cash flow, you will low single digits. At this channel, what we love to see is a double digit over here. I'm going to see something that's 9, 10%. And in this market, we are going to be able to find it. I promise you that we will find it 9, 10%. On my cash flow club channel, I'm posting shares or companies that are yielding that type of cash flow. So check those out. But this is a growth stock, so you've seen that. Now, let's do a forecast. Let's figure out what this company's worth. All right, now we got to forecast the business. So how do we want to forecast? Well, number one, the company provided us guidance. So let's take a look. I'm just copying the revenue that I have above to make it easier to stretch it forward rather than following the template. So this is the revenue that they've already produced, right? This is done. This is the growth rate that they've produced. The company's saying fiscal 2023, I'm going to produce about $31 billion of revenue. That's a 20% growth year over year. Now, if I look at EBITDA, here's the EBITDA they have historically. Here's the EBITDA margin they've had historically. It grew to a peak of 16%. It's down last year at 11. They had high R&D. They had higher, the share-based comp itself expensed, brought margins down. And what I'm doing is I'm saying that margin is going to stay, if not a little lower, out long term, because I want some cushion. We're already giving them the top line forecast. I'll say that the margins stay down a little bit as cost pressure, they have to pay more for their employees. And I'm going to stretch that down into the future. We're going to come down and we're going to see what this looks like. I will take growth rates from 20% down to 10% annually, which I think is okay. It's less than I had last year because the dynamics changed. I want a little bit more caution. But that puts them just shy of $100 billion of annual revenue 10 years from now. And at a flat 11% EBITDA margin, that means they're about $10 billion of top line, EBITDA growth. Now, I think they might be able to beat this. There's no scaling here. If you triple revenue like you have and you flat margin, they should be able to lift margin up as they build that subscription base. But to be cautious, again, because the risk dynamics have changed, I'm giving it a lower margin, and I'll say 10%. $10 billion out 10 years. That's still, by the way, a tripling of EBITDA. That's still a strong number that they have to achieve. Now let's go see how that translates into cash flow. Before we get to cash flow, I want to continue the forecast here. What I want to do is I'm going to show you the share-based comp. Now right here, this is the amount of money that they're expensing in the share-based comp. And you can find share-based comp in the cash flow statement about 3 or 4 lines down from the top under amortization and depreciation. Typically the next line is share-based compensation. And you can see that's grown from $500 million a year to $2.8 billion last year. What was EBITDA? EBITDA, well, that's after. What was cash flow? Let's go take a look at cash flow. Cash flow last year, $6 billion in cash flow from operations. Well, that's after adding back this $2.8 billion. So I net those two, and I get $3.2 billion of adjusted cash flow from operations where I expense the share-based comp. And what that does is basically halves the cash flow. And if I take that out into the future, following the same growth rate of EBITDA, I get basically a tripling of a lower number of cash flow, roughly $12 billion of free cash flow. I subtract an estimate of CAPEX that they need to expense. And I get the cash flow to equity, us, assuming no change in debt. I'm just going right from $3 billion to basically $9 billion of free cash flow. I don't change the share count because I'm expensing the share-based comp, so I don't need to add dilution. And I go from $3 to $9 of free cash. Let's pop this into our forecast and see what we have for pricing. Okay, really quickly, EBITDA forecast. Here we go. $3.5 billion next year EBITDA to 10. I'm giving an 18 times market multiple, which is much, much lower than what they've currently have, right? What they're currently at is 76. It's been a lot higher, so this is going to come down over time as growth stabilizes, and it's going to come down to a healthy 18. And this reduction in the market multiple, the number of times that investors are willing to pay for earnings, that reduction is going to weigh heavily on the price target. It's going to be very hard for the company to overcome that. That's $186 billion of value, less some debt plus some cash, $177 billion of market cap. Divide by the shares, I get $179.54 for a long-term price target out 10 years from now. Let's look at cash flow. Now, cash flow is the same thing. I showed you the forecast earlier, got $3 and change up to $9.15. I grow that and I give it a 4% yield, which is higher than what you had very, very low single digits, a 1% that I showed you historically. This is a 4% yield, and it equals a $228 price target out long term. Now that we have price estimates, let's see what the stock is trading at today. All right, we have 2 price estimates. The first one, free cash flow. The second one, market multiple. I have the 2 because I don't know which one to believe in. I'll just split the difference. And I get basically $200 a share. Now, when I look in the market today, and this is going to change, the market's crazy, but right now it's $169 per share, which if we look at the forward EBITDA is still 50 times forward EBITDA on an enterprise level basis. It's still very, very expensive. So I'm gathering it's going to be difficult for us to have enough cash flow to generate a sizable return for a stock that doesn't move a whole lot over 10 years. Here we go. Let's drop it in. We got $169 I can buy the stock at today. I've got a cash flow stream here, which we've reduced for the share-based comp that we're just expensing now to make sure we maintain the employees. And what happens is my IRR is only 6%. And that's a function of mediocre price gain and a much lower cash flow forecast than we thought because we had $6 billion of operating cash flow but that excludes $2.8 billion of stock-based comp dilution to you and I, the equity owners, that they're giving to their employees. Now, the employees deserve it for sure, but I need to compensate the price of the stock for what's going to happen in the future. Let me toss this into an IRR, into a distribution curve so you can take a look. At $169 with this forecast, it's 6%. If the price falls back closer to $100, I think it's starting to get a really, really attractive company, but I would wait for it and see what the company issues in guidance. As for a score, we're going to give it a meh. Why? Because we like the business itself. The business itself is very good, but it's very expensive. Let's review the 5 key attributes. Number 1, top line revenue growth. Check the box. Yes. Number 2, EBITDA growth. Check that. Absolutely. Number 3, strong free cash flow. Yes, I'll give it strong. Even though we haircut it, it's still strong. Number 4, low debt. Yes, 3 times. Number 5, well priced. No. It's not well priced. It's still too expensive. The stock could actually have in value again, right? Because if it's 50 times EBITDA currently, you bring it down to a 25 times, that's a halving in stock price. All right, so if this thing is less than $100, I think we really start stepping in and buying heap loads of. Right now, I'd wait for it. Now, what I'd share with you right now is go to my website, cashflowinvestingpro.com. Take my course, learn to build forecast models for yourself to create a focused portfolio. I'm a big believer that the indexing is dead. You cannot buy 100 different stocks and expect to get your retirement where it needs to be. You need to buy 20 to 30 of the best companies that are out there, and you wait for the best price. How do you do that? Take the course. I give you the forecast. I give you this forecast model. I show you how to read 10Ks, how to build a forecast, how to calculate cash flow, how to calculate your IRR, and how much of an IRR you should have, and how to build that portfolio of 20 to 30 stocks that you can hang on to for a long time. And then go live your life. Let the stocks perform. Let the management do what they're going to do. Sometimes you're going to be up, sometimes you're going to be down, but go live your life. Don't live in front of the computer, and let the companies perform. You can also, on that website, find my one-pager, the Cash Flow Club. This is a monthly subscription club where I publish one-pagers. I also have a couple analysts that are publishing for us as well. As we grow the subscription base, I'll grow the team that's publishing in there, and we'll expand coverage more and more. Again, in the description below, there's a link that you can find that'll give you a free download of a one-page. You can get a feel for what it looks like. Thank you very much for watching. If you liked the video, share it with your friends, share it on social media, and give it a big thumbs up. Hit the subscribe button. It really helps the channel out. I really appreciate it when you do it. This is a lot of effort. Thank you for doing the extra subs. I really do appreciate it. Up here, we're going to pop a couple other videos that will show you some other value cash flow analysis approach for some stocks. If you want to check those out, feel free to do so. Thank you very much for the time. This has been Salesforce, a review of rational investing. Throw me a comment down below. Tell me what you want to see next. Bye-bye.